Hello everybody! June is turning out to be a bit of a equity raising month for REITs. So plenty of rights issues and placements done and coming up as well. Not that surprising because I held the view that the REITs are quite expensive, especially those in the STI index. So if you are the fund manager and you think that the REITs are quite expensive, you'll probably be rushing to issue paper as well to increase your FUM. I'm a bit surprised that the AIMS did the rights issue. They did it at the 1.189. The even more surprising thing is that I managed to buy at 1.17, and this is not momentary. It was there for actually hours. In fact, I think it was there for 2 days to offer. So you have bought as much as you want at 1.7. I really don't understand why people are buying at 1.189 when they could have bought at 1.17. It was there for a very long time actually. I think in general this is gonna be a short-term drag, but long-term plus though. So which is why I actually bought at 1.17. I think in the long term this is gonna be a good thing. That's why I bought it. So this was the last slide as of my last review of AIMS APAC. And if you look at the dynamics and so forth, I had the conclusion that I should just hold on dear life for this REIT and collect the juicy dividend yield and wait for a re-rating. The share price performance subsequently was actually up to my expectations. So look at it, the share price after the review was kind of on an uptrend, reaching a high of 1.42 or so. Even at these levels, I thought the REIT was not expensive. I think this stuff should be trading at like 1.1 to 1.2 times a book, at around 6 to 6.5% dividend yield. Especially on the back of its strong fundamentals and very strong balance sheet. So I was happy to hold on and enjoy the dividend yield, but unfortunately, downturn of REIT sentiments, subsequently the equity placement, meant that the share price went 1.17, back to where I bought in late 2022. So if you follow the channel for thus far, actually more than doubled my position in AIMS in the late last year. I thought it was a gem. This price was just idiotically low. Unfortunately, the turn of events meant that I pretty much went back to where I was 1 year ago. But nonetheless, throughout the past 9 months, collected around 7 cents of dividend, right? So the total returns was okay. So the rights issue was a bit of a strange thing, because when I calculated the amount I have to fork out, the actual quantum of the cash I have to inject is actually very little. So the rights issue was 35 for 1,000, so it's just 3%, right? So in general, so essentially, the REIT gave a something like a 8% dividend yield, right? So if they are asking for 3% rights issue, essentially they're taking less than half of the money back for the AI. So I thought it was quite strange that for a relatively small issue, they have to do a rights issue. The even more bizarre thing was that the rights was at 1.189 and I bought it at 1.17. I actually bought what I was entitled to in terms of the rights, and I bought even more shares at 1.17. So essentially skipping what we have done at the ATM. So if the share price had not collapsed, I would have subscribed to all my entitlements and did access units subscription at the ATM. But well, since everything's at 1.17, so like 2% lower than the issue price, I just bought everything at one go. And this was done at 12th June at 9:05 a.m. right. So I'm not very sure what happened, but on 12th June and I think also on 13th June, things just collapsed way past 1.19. I was there all the time. I just placed an order and everything was filled. So this was the DPU as of last year. It was 9.5 cents. I thought with the growth of the rentals and stuff, they might hit 10 cents this year. But unfortunately, the equity placement meant that you're gonna have a DPU hit this year. There's gonna be drag on the DPU because the equity is raised today, and the units will increase today. But the contribution will come a very long time away because this is an AEI and not a acquisition. The acquisition was quite strange. Out of 100 million raised, only 32 million is used for a specified AIs, and 65 million is for potential AIs, right? I thought this was quite strange because 32 million for the AIs is just so little, right? And then if they need to raise 65 million in the future, then do it in the future, right? In general, I think the AIs should be funded by DRPs, so dividend reinvestment plans, especially if the AI is small, right? And this is not a big AI, so why do a rights issue and depress your units and cause all these problems? Just do it by DRPs, right? I thought that I was quite disappointed though that if you're gonna do a fund raising, equity fund raising, I would love it if they do accretive acquisitions, especially in this environment where cap rates are rising and funding spreads are negative, and you have distressed sellers and valuations under pressure. I would have loved it if they did a rights issue, take the money and buy some distressed assets in Australia with freehold status, and then issue the units immediately, and that and get accretive contributions immediately as well. So there's no drag and no nonsense, right? So I was quite disappointed by the whole exercise. I think there's gonna be DPU drag for months. I think DPU for this year will probably drop below 9 cents, so yielding around 7 to 7.5% dividend yield. Whereas it could have been like 8%. So a bit of disappointment. But I think eventually there'll be an NAV boost because you do the AIs and valuations go up, and therefore NAV go up. This will have a good effect on the gearing as well. Because if your properties are gonna get a valuation boost and you keep your borrowings the same, then your gearing will go down naturally. So I think in general it's quite okay, which is why I bought more units than what I was entitled to. I think that actually MIT Maple Tree Industrial Trust. Actually, I bought a whole lot of this bunch of REIT in the past few weeks. Actually, I thought about it previously. This was one of the biggest buys that I had for the past 1 month. In fact, I raised the proportion of this REIT in my portfolio to around 9%. So just hammering away at 2.18. I thought MIT was gave a prime lesson on how to perform AIs. So they did this AI at Kallang Way, right? So Maple Tree High Tech Park. So the valuations are 291 million, and I think they committed around 200 million for the AI, and they actually funded this whole thing through DRPs, which is really nice, right? Because you do a DRP, you just give a 3% to 3% discount to market price, and you get the committed and you get the loyal shareholders to do the DRP take up, and actually there's no need to do a placement at a 10% discount to market price, right? Do a DRP every quarter and get retain the capital and do AI gradually. What's the big hurry? If you look at it, they probably spent around 200 million on the redevelopment, and it was pretty much all funded through the DRPs. They raised 184 million from the DRPs for around 1+ year, and you see everything was funded nicely. And in the meantime, because there wasn't a big share issuance drag on the DPU, they could maintain the DPU very very nicely for the entire year, which was brilliant, right? I think MIT is still a brilliant REIT manager. Really nothing much to say except that they're really, really good. Which is why I'm very happy to buy the units. As of my last video, there were actually negative comments on MIT and so on and so forth. Well, I'm not gonna disagree, but I think the quality of the management persuaded me, as well as the fundamentals for the data centers, convinced me to take a big stake in this REIT for the past 1 month.